Hey everybody, Frank Finance here. Hope you're having a wonderful day. Today we're going to be doing a stock analysis on Realty Income, ticker symbol O. In today's stock analysis on Realty Income, I'm going to give a price target, a brief business description. We're going to look at Q3 2021 results. We're going to look at the fundamentals, the price history versus some of its peers. We're going to look at the stock price history of O itself. We're going to look at the recent acquisition news with REIT. We're going to talk about the spinoff of the office REIT from that acquisition. And I'm going to give my final thoughts on Realty Income as an investment. For those who have seen my content before, thank you for watching again. For those who are new, I do videos on personal finance, investing, and stock analysis. So if you're interested in those topics, please consider subscribing. Now to your content. All right, my price target for Realty Income is $80 in the next 12 months, or indicating about a 14% upside. Now, Realty Income's risen about 8% in the last month, and I do believe it could possibly trade back down into $65 range in the short term. Now, there are some macroeconomic concerns, specifically around the Omicron variant. I personally don't believe this is going to affect Realty Income, as there's not enough data out there to indicate that there are going to be further lockdowns. Right now, that is something that you're just going to want to stay attuned with. And if you think there are going to be further lockdowns that affect property and tenants specific to Realty Income, that is something you're going to want to pay attention to, as it will cause that stock price to more than likely dip below $65 a share. Right now, I'm not really concerned about that situation. Moving on to the earnings report, in Q3 of 2021, Realty Income reported funds from operation of 85 cents per share compared to analyst at 91 cents. They've missed that by 9 cents, or about 10%. On the revenue side, Realty Income reported $486 million in revenue, and they beat analyst expectations by $27.36 million. Now, Realty Income, since their earnings release, came out with a business update. Basically, they're going out and buying $1.1 billion. Now, this is subject to letters of intent and everything being approved through the acquisition process. But basically, they have $1.1 billion of property that they're looking to purchase and close on by the fourth quarter of 2021. Now, in order to do that, they had to raise $1.5 billion in capital. They did that through raising 950 of that through the sale of 13.6 million shares. So they increased the amount of shares outstanding by issuing new ones, and they raised approximately $595 million through the distribution from Orion's, which is the company that was spun off from the merger with REIT, and then both those companies spinning off the office part of the business. Now, I'm a pretty big stickler on shares outstanding increasing, but in this case, since it's for purchase of hard assets that are going to retain their value and are going to be income producing for the long term, this is actually, I think, a pretty good move in terms of how they are raising capital for this purchase. So it looks good to me. No concerns with this. Now for a brief business description. Realty Income is a real estate investment trust with about 6,500 properties currently. And with the recent merger with REIT, that will add on, or has added on, 3,800 additional properties. Now, Realty Income operates triple net leases, and what that means is the tenant in the property will pay the taxes, insurance, and maintenance on the building as long as they are tenants. On top of those costs, they pay a lease payment to Realty Income for being a tenant of the property. Now, it's a relatively higher margin setup for a REIT, mainly because it's a lower cost to Realty Income to manage. Now, Realty Income has their own overhead. Basically, you got your people doing their financials, you have people looking for new properties, and then they also have to have people manage the properties, whether they're having an independent property manager do it or they have folks doing it themselves. But even if they have an independent property manager do it, I'm sure the percentage is lower because at the end of the day, Realty Income is not responsible for the maintenance as long as there's a tenant in the property. All right, jumping into the top 20 tenants that Realty Income has. 7-Eleven is top, Walgreens comes in number 2, Dollar General at 3, FedEx at 4, Dollar General and Family Dollar at 5, and you can see some of the larger names like LA Fitness, AMC Theaters, Regal, Walmart, Lifetime Fitness, Tesco, BJ's, Home Depot, Circle K, CVS Pharmacy, Kroger, Fast Mart. As you can tell, these are pretty strong names, pretty large companies Very good. And in terms of the companies that were exposed highly during the pandemic, you had Lifetime Fitness, AMC, and Regal. Pretty much theaters are on their way back, and AMC was one of the ones that was a candidate for bankruptcy, and that's now off the table, so no worries there. I would say that gems are still kind of iffy, but overall, collection rates are pretty close back to normal. Moving on into property type diversification, office has now been rolled off and is at 0% because they had the merger with REIT, and the office part of the business was rolled off into it had a spinoff to Orion REIT. So that is no longer a part of the portfolio and property mix for realty moving forward. So 1.5, 12.2 per industrial, and 83.7 for retail. Technically, all those numbers are a little bit higher now that the 2.6% of their portfolio in office is now no longer a part of it. All right, jumping into occupancy, Realty Income is in orange. The S&P 500 averages are in blue. As you can tell, their median occupancy rate over the last 20 years has been around 98.2. They're solidly over that at about 98.8, which is actually higher than where they were pre-pandemic in 2019 at 98.6. Now, they had a slight dip in 2020, probably due to the pandemic, more than likely. And you can see that their median occupancy rate compares to the average, or the S&P 500 REIT at about 93.8%. And currently, you can see that occupancy rate for just Q3 is significantly higher than the S&P 500 REIT. Now, one thing I just want to note here is from an occupancy perspective, you can see that they've done extremely well over the last 20 years with occupancy. They had a few years post 2009, which caused a lack in occupancy in those buildings. But I think this really speaks to the quality of their locations, more so than the quality of their tenants. All right, now this is an older figure as it comes from the end of 2020, but I think it's a really good thing to note. When they are looking to acquire properties, they're looking for things they can lease from 10 to 20 years. Now, currently, as of that time period, their weighted average release term was about 9 years. So that just shows you that they have a good, secure future cash flow pipeline for at least, they're not going to have any issues in the short term. All right, jumping into the financials for Realty Income, you can see that their 2020 full year results came in at $1.6 billion, and for the trailing 12 months, they're at 1.8. Looks like they're growing at a relatively normalized clip, going from 1.48 to 1.39, and probably going to increase that to the 1.85 or 1.9 for the full year. So looking at a decent growth rate in their rental revenue. Now, on the property expenses, these are also going to increase as they continue their acquisitions. I believe they're going towards almost $7 billion in acquisitions in full 2021. So I think we're also going to see this increase substantially from this 117. I'm not going to guess and speculate what it's going to go to, but it may probably over 120, probably closer to 130 if I was to guess. So operating income, I expect that to have quite not a huge jump for 2021 as the acquisitions are going to close, but we're going to see I think a pretty large jump from 2020 to 2021. Looking at continued operations, I should just go down to net income. So looking at net income to companies, so we're looking at 474 for 2020 and 396 for 2019. So overall, they've done very good. They've done well at keeping their earnings per share relatively stable in comparison when they're doing all their acquisitions. So overall, Realty Income has done quite well in increasing revenue for the type of business they're in. All right, moving on over to the balance sheet. Realty Income is a real estate investment trust, and as expected, you see a large percentage of their assets as gross property, plant, and equipment. Actually, it's above 100% as depreciation takes that number down considerably. So their total assets is at $23.71 billion. And if you look at their liabilities, their total long-term debt is at 8.9, and total liabilities is at 10.3. Now they are cash on hand relatively pretty poor, but they do generate income monthly, which they try to keep this they keep this fairly small as a percentage of their current liabilities. So when you compare their current liabilities to their cash, they're more than covered. So don't get concerned when a lot of their assets are tied up in property. They are generating income monthly at quite a nice pace to cover their debt load. All right, next up we're going to do a price performance versus peers. On this we have O stock in gray. We have VNQ, which is an index, Vanguard REIT index, in blue. STOR, which is a triple net lease REIT as well, in orange. And we have in purple, we have NNN, which is also a triple net lease REIT as well. So looking at the 1 year chart, you can see that the index has performed better than all three of them as solo. That includes other non triple net lease companies as well. So you can see from a performance standpoint on individual stocks, O is kind of there in the middle, with NNN doing well in the 1 year. Stretching that out to the 2 year mark, you can still see the VNQ, which is the index for the REITs, has done about 20%, and all the other REITs are actually negative for that time, between 6% and negative 12%. Pushing that out to 3 years, much of the same. VNQ's up, and the other ones are considerably down. Stretching this out to the 5 year mark is where we start to see one company, the STOR, actually outperformed the index by about 5%. O underperformed the index on a 5 year basis by almost 10.5%, or sorry, I should say 15%. One thing to note here on price performance, these don't take into account dividends, but since most of these are REITs, they all pay dividends. Now they're not of the same, obviously not the same. But if you are trying to do total return versus price return, just keep that in mind, that this does not include dividends. So pushing this out to the 10 year mark, you can see that O has actually outperformed the index by about 5% over a 10 year time frame. And the other two have gone 15% and another 25-ish% below what the market has been able to bear. So if you look at this price performance over the last 10, 5, and 1 year, you can see that O has been underperforming the market index in the last 5 years essentially, and there is some opportunity now as O was starting off. If we're looking at the 10 year mark, you can see that they paced fairly well with the index, and they took off. I think this is in the 2016 time period. And there's a lot of divergence. You can even see, like pre-pandemic, they were considerably higher than the market at that time. They were up 124% over almost 8 years, and the VNQ was up 60%. So if you're doing that comparison, it was very, very outperforming. But you can see as we had the COVID and pandemic over that time period, the multiple attached with O specifically is not nearly where it was pre-pandemic, and the VNQ has actually recovered quite well. And it's probably more that people are buying baskets instead of individual stocks to help hedge their risk from the different REITs out there. Some are more into theaters, some are less. Some have pretty solid collection rates that have nothing to do with the pandemic. It doesn't matter whether there's retail sales. The housing REITs are probably still having fairly high collection rates depending on where they're located. So I know I'm kind of getting to the details on why that is, but you can see that over time, O definitely was outperforming the index. And I think it may get back over to that, but we're going to have to see some stability, and it's probably going to take multiple years before we start to see a significant outperformance of O versus the index. All right, moving into stock price history over the last 6 months, O stock has basically been flat, only down 0.07%. Moving out to the year, they're actually up about 15%, so a decent return over a year mark. If we bring that out to the 5-year mark, we're starting. I kind of want to bring attention to where they were trading pre-pandemic. So they're trading a little under $70 a share, just right up until we saw the big drop in March. Now, from a historical perspective, they've only been above 60 for a relatively short amount of time. You saw that happening in early 2019, all the way ending in the end of 2019, early 2020. They had hit $60, or so close to $70 a share back in 2016, but we really didn't see that hold until 2019. Now, the reason why I bring this up is it may take some time to get back up to those all-time highs of $80, and that's why the price target is where it is. I do believe it's a possibility we could hit that $80 range by the in a 12-month time period. However, you just have to realize they are growing as a company. They're going to have more stronger cash flows. They've continued their acquisition and their buying. But again, historically, as they issue new shares to make these purchases, they have to be accretive in order to continue to drive up the stock price, because it's still diluting you as they issue new shares to buy stuff. Now, I think they're keeping up with that. I think their acquisitions have been fairly good. You just have to realize from a price perspective, you will see this bump off of resistant levels once it gets there. So even if it bumps off of 75, or if it gets to 80, it's probably going to bump down, just because those are natural resistance lines from the past, and that will probably occur again. All right, jumping into merger news, Realty Income and REIT. They actually closed their merger on November 1st of this year, 2021. Now that that's done, in future earnings, I expect that they will consolidate their financials, and you'll start to be able to see what this looks like. So right now, they're just put on the investors page. They're both putting both of their press releases separately. I tried to go through and combine those, but it was going to get very messy and really hard to look at historical prices over time. So I'm just going to let it go for a minute, and once those things consolidate, then we can take a little bit diver deep on some of the synergies we expect for these two companies. Now, as a part of that merger, they were actually going to take all the office buildings that were a part of that merger, some from REIT, some from Realty Income, and spin those off to a new company. The new name of that company is Orion Office REIT, and that spinoff has already occurred as well. So if you were a owner in REIT or OStock, Realty Income, you should probably see some shares of Orion Office REIT in your portfolio. At least as of today, that is true for my portfolio, so should be for all investors. All right, now for my final thoughts. I believe Realty Income can reach $80 a share in the next 12 months, or about a 14% upside. Now, the thing you have to remember here is they have risen about 8% in the last 4 weeks, and I think they're going to bump up against that resistance level at the $70 and then again at $75. So we could see it move back into the $65 range in the short term, and there could be other downside if we see stuff happen with Omicron or other macro events that affect specifically triple net leases that are specifically that are highly inside of the retail industry. Now, from a financial standpoint, those financials look very solid. They're consistently growing their revenues as well as net income, and they're also considerably going out and expanding their profile every year. In 2022, they're expecting about $5 billion in new, growing their portfolio by going out and purchasing new properties, and they have consistent growth. I think their CAGR is somewhere around 4.5%, which is pretty good for a REIT of their size. And for those who like dividends, this is great for retirees with about a 4% yield. And not only is it 4%, it goes out monthly. So you don't have to wait every quarter to go out and get your dividend. You can receive it monthly, which is really helpful for those who are retired. Now, for me personally, this is not a super tax efficient stock right now. REITs, you don't really get long-term or you don't really get favorable dividend distributions for REITs specifically. So I'm paying you pay higher ordinary income tax on these REITs, and so that for me is not actually not favorable. So in this time right now, I'm not really looking to expand my position in Realty Income, but if we do get close to that price target, I will be consider selling my position, as I do believe it will start to bounce off of those resistance levels as it gets there. So I do believe it has good upside. Downside's fairly limited, unless something changes as it relates to COVID-19 or something else unforeseen. If you like this type of content, please consider subscribing. I do videos on personal finance, investing, and stock analysis. And if you found anything helpful in this video, please hit that like button. Thank you so much for watching. Frank Finance, out.